You know, when we think about life insurance, our minds usually go to one place. It's a safety net for our loved ones after we're gone. But what if it could also be a lifeline for you while you're still living, right when you might need it the most? Well, today we're going to explore exactly how that works.
So let's just dive right in with a question. It's something I think a lot of us worry about, even if we kind of push it to the back of our minds. A serious illness hits your family. What really happens to your finances? For most people, a major health crisis creates what you could call a financial double hit. On one hand, your income can drop or even disappear because you can't work. And at the exact same time, your expenses are shooting through the roof. We're talking medical bills, deductibles, maybe travel for treatment, all the things your health insurance might not fully cover. But what if your life insurance policy had a feature baked right in that was designed for this exact problem? An unexpected financial lifeline, just when you need it? This is exactly where living benefits come into the picture. This slide just lays out the core difference perfectly. On the left, you've got traditional life insurance. It's built for one single event, death. The money goes to your family. But look at the right side. With living benefits, you add this whole other layer of protection that allows you, the insured person, to get a chunk of that money while you're still alive if you have a qualifying health event. Now, I want to be super clear about this. This isn't some extra magical money. It's still that one pool of money, the death benefit. This feature, which is often called an accelerated death benefit, just lets you turn on the tap and get some of that money early. And when you do, the remaining benefit for your loved ones is simply reduced. It's an advance, not a bonus. Okay, so how does this actually work in the real world? It's not as simple as, if you get sick, you get paid. Oh no, it's very specific. And it usually boils down to 3 common triggers that can unlock the benefit. So the first trigger is for chronic illness. And what's interesting here is that this isn't about having a specific disease like cancer or diabetes. Instead, it's all about your ability to function. The benefit can kick in when a doctor certifies that you need substantial help with basic daily activities or if you have a severe cognitive impairment. And when they talk about those activities of daily living, or ADLs, these are the specific things they're looking at: bathing, dressing, eating, toileting, transferring, like physically getting out of a bed and into a chair, and continence. If a doctor says you need help with 2 or more of these, it can trigger the benefit. The second trigger is for critical illness. Now, this one is all about getting a specific diagnosis. But, and this is a huge but, the condition has to be on the specific list that's written into your policy's contract, and it has to meet the exact definition they use. And we're talking about the big ones, right? Things like a heart attack, a stroke, invasive cancer, or major organ failure. These are the kinds of events that can create that financial double hit we were just talking about a minute ago. And the third trigger, terminal illness, is often the most straightforward of them all. This one gets activated when a physician certifies that, sadly, your life expectancy is limited, usually to a period of 12 or maybe 24 months, depending on the policy. Now, it's really easy to hear all this and get it confused with other kinds of insurance that you've probably heard of. So let's take a second and be crystal clear about what this is not. First off, let's compare this to long-term care insurance. Now, a chronic illness rider can give you cash you can use for care, for sure, but remember, it's an acceleration of your death benefit. A dedicated long-term care policy is a totally separate product, often with a much bigger pool of money specifically designed for those long-term care costs. And it's also not disability insurance. They're completely different tools for different jobs. Disability insurance is there to replace your paycheck if you can't work. But you could be disabled and unable to work and still not have a specific diagnosis, like a heart attack, that would trigger a critical illness benefit. See the difference? They solve different problems. So what does all this mean? It means that if you're shopping for a policy, you have got to look past the shiny marketing headlines. The real story, the stuff that actually matters, is buried in the details of the contract. 2 policies can both shout living benefits from the rooftops, but work in completely different ways when it's time to actually make a claim. So here are the key things you need to look for in that contract. First, rider scope. Does it cover all 3 triggers or just one? Then, trigger definitions. How exactly does the policy define a heart attack? The specifics are everything. Payout structure. Do you get a big lump sum you can use however you want, or is it structured monthly payments? Caps and limits. What's the absolute max percentage of the benefit you can access? And finally, discounting. This one is critical. The insurance company is paying you early, so they're going to discount the payout based on your life expectancy. You need to understand how they calculate that. All right, so all of this brings us to the most important question, right? Who is this actually for? Let's walk through a couple of practical scenarios. Living benefits can be a really strong fit for a lot of people, but they're especially powerful for any household that depends heavily on someone's income. We're talking about younger families with a mortgage and kids, pre-retirees trying to shield their nest egg from disaster, or even single folks who want to protect their own financial independence if they get sick. Okay, let's make this real. In this first scenario, imagine a young family. One of the parents gets a critical illness diagnosis. They accelerate a portion of their life insurance benefit. And this money isn't just for medical bills. It's to cover the lost income, pay for extra childcare, and keep their savings from being wiped out. It lets them focus on getting better, not just on staying afloat. Or how about this one? Picture a 58-year-old, just a few years away from retirement. A major health crisis could force them to raid their 401k or IRA way too early, messing up their whole plan. Instead, they use an accelerated benefit as a financial bridge, protecting those precious retirement savings and keeping their long-term goals on track. So what's the bottom line here? Ultimately, the best policy is the one with clear triggers, math that makes sense for the payout, and a price you can actually afford. Because the most powerful feature in the world is useless if the policy isn't in force on the day you actually need it. And that really leaves us with a final question to think about. Is your financial plan built just for that one final crisis? Or is it built to handle the many other challenges that life can throw at you along the way? Because true financial protection isn't just about what happens after you're gone. It's about protecting your life while you're busy living it.